there. A very good morning, good afternoon to all of you, depending on wherever you're watching me. This Simply Stocks, and I'm here with another video. And this time, this video is on market Gurukul, video number three, I suppose. And this is about all about investing. Session B continues, and we'll talk about the financial mumbo jumbo, what all comes into you can say analyzing with respect to understanding as to how the valuations of the company would be. So let's get started. First of all, disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do with their own due diligence and research. I am not a member of the NSE and BSC. I am not a portfolio advisor, and whatever decisions with respect to now, before I talk about this financial mumbo jumbo stuff, let me just request you to kindly support me through Patreon or WhatsApp or on YouTube. You can get access to my portfolio, my watch list, and also you'll have queries you'll be having. I'll be very much eager to answer that. Plus, I'll talk about global and Indian economy, plus different types of stocks, short term, long term calls, etc. All is in there, so you can check that in the description. So let's begin with this session on the financial things or aspects that we look into, or at least I look into when I analyze stocks from a long-term point of view. Whatever I discuss here is from a point of view of 4 or 5 years. So a number of different matrices are used with respect to qualitative and quantitative analysis of analyzing any stock or company, and these are macro micro factors which I'll discuss in this video, which need to be assessed in order to understand as to how the company is doing or how the company is going to do or the business is going to do going forward, uh, globally as well as in the nation, or you can say domestically. So global factors and threats are also inbuilt in assessing the valuations, and valuations are extremely relative in nature. So how are stocks valued is extremely crucial. And when we talk about valuations, you can have a stock trading at a PE of 100, and somebody will say that it is extremely expensive. Others will say, okay, it is cheap because it was trading at 200, 250 times. It has now halved from there, and the earnings are coming through. So it is extremely relative in nature for every individual, in terms of risk taking ability of that individual. Because if somebody is buying a stock at a PE of 100, say for example, and this is just pure examples that I'm quoting, say a Keynes Technology trading at a PE of 120, 130, say a Dixon trading at 120, 130 at the moment, and probably you believe that the growth is going to be 70, 80%, then, and if it comes through, probably 100, 120 PE is justified. But if that doesn't come through, then the PE will shrink dramatically. So again, it's somebody's ability to take risk on a particular company that probably signify as to how much of a valuation he's ready to give and ready to accept in terms of buying the stock at that price. So I might not be eager to buy, say, a Dixon at 120p, and I'll wait for a for the PE to shrink, say about by about 20%, and then only I'll say that there will be margin of safety. So valuations are extremely, you can say, relative in nature and can vary remarkably among sectors and with firms in the same sector. So just to give you an example, the sector PE for suppose 5 7 years back, the PE of sectors in the government space, or the PSU space, used to be in single digits, the P 5, 10, 8, 12, or something like that. Even currently the PE of, say, a Coal India, etc., is at low PE, and normally that happens. Or and then you have on the other side, or other spectrum, on the other side of the spectrum, you have the consumer stocks that are trading at 80, 90, 100 PE or even beyond. So there is no strict format of assessing all companies, but assessing the optimum valuation is essence of making money. So you need to understand as to how the valuations would pan out, or how the valuations will be going forward depending on the growth. Again, it comes down to how you assess the growth, say from a 8 year period, or from a from the next 2 3 year period, whatever your time frame is, with respect to putting the money into the market. Say if you're buying into a stock from a 3 year perspective, you need to understand how the numbers are going to be from a 3 year perspective. So just to give you an example, I have opened up, say, a Fortis Healthcare, and let me just give you an idea of Dixon Technology, because I have been following this stock for the last since its you can say IPO in 2017-18. So in terms of Dixon Tech at around 14,700, and this is a pure example of gauging valuations, etc. It is trading at 89,000 crore market cap. It is trading at a market cap to sales of 2.3 at the moment. And if you look at it from a point of view of its numbers, from a yearly numbers, it did around 39,000 crores of sales this time around. Now, how will you gauge as to how the numbers are going to be in FY26 and 27? One way is to look at their management commentary. If the management is top class, have a very good pedigree, and those companies that are probably that have been around 4 5,000 crores of market cap, which Dixon was earlier, and have grown to around 90,000 crore market cap, and some market leader in its space, is the biggest company. Probably the management is quite trustworthy in that sense that the stock has gone up 25x from the time from the time the IPO came in. So in that regard, whatever the management says, probably 70 80% could come through eventually if things stay the same. So supposedly, and I have not gone through management committee, supposedly the management comes out and says we are going to grow at 30% for the next 2 years in terms of sales. And normally when the management say that they're going to grow 30%, it means they're going to grow on the sales front, and normally that's how it is. And if it is from the profit front, then they'll mention it explicitly. uh, Coming back to the numbers, so suppose 30% for the next couple of years, that means you can easily gauge that okay, 39,000 crore rounding off is the sales at the moment, and going forward they'll do around 50,000 crores, and in 2 years time around 66,000, purely based on that. And if you go through 3 4 management commentary, you'll understand whether the margins will remain the same or not. Let's say if they have said that the margin is going to increase from around 3.9% to around 4.5%, so at 66,000 crores, that this is what I do, and this is what you can do. Probably 66,000 crores, you can do okay, a margin of 4.5%, around round about 3,000 crores is going to be the operating profit, versus the 1,500 crores that they are doing right now. So the operating profit may double, although the again the sales will also nearly go up around 60 70%, because the margins will go up in the next couple of years. So that's how you're going to gauge, and eventually you'll come down to a profit figure. So if I do this, there'll be another income factor of around 100 crores in there supposedly, and interest and depreciation, you need to add this up. So this is around 430 crores. Let's say this doubles up to around 900 crores or so. If this continues to go up, then they are going to do on, say, the if you look at it, the tax expense is around 21 24%. So let's say 22%. Eventually we end up at around say 1,700 crores of net profit, versus 1,233 crores, and this is a swelled up net profit. So eventually you end up having a figure on the EPS front, which is going to be around 250 251 rupees. Now based on this 251 rupees, and again this is all fictitious, just to give you an example, I have no idea how the numbers are going to pan out. I have no idea what the management has said, so that's a disclaimer. But around 250 rupees, if you look at the current price at 14,600 700, then we are looking at a scenario where the stock is trading at 59 times 2 year forward. Now whether you're ready to give this valuation of 59 times 2 year forward, you think that the stock is currently overvalued, undervalued, based on that you'll make your decision whether to buy or not, whether the whether the market will give a valuation of 100 times, which is the current PE of the stock or not. If you think that the a market is going to give a P greater than 59, then probably you're going to make money and probably you'll buy around these levels. Otherwise, you'll leave it and you'll find out an optimum level to buy. How are you going to find out an optimum level? I have talked about it even in my last video. You'll just at least you'll look at a 10-year, 5-year average and then a 10-year average. The 5-year average on a PE front is around 128. 10-year average is around 104. You can probably make an average of it, of these two, and you'll come out with a figure here as well, which is around 116. So probably if you believe uh, that the market is going to give a PE of around 100, even 2 years from now, even on a growth of 30% sales growth, then probably you'll buy. Otherwise you'll just leave it. So that's one way of doing things. So this is how things pan out. This is how valuations are probably tracked. This is just one way of how you'll track valuation. There are many other ways. Probably I'll discuss that in later videos of Market Gurukul when I do that on subsequent Fridays. But the quarterly assessment of your investment is extremely important. You need to understand how the numbers are. There is no strict format of assessing all companies, and so valuation assessment need to be done on every 3 month basis, even if you're investing into the market from a 3 4 year perspective. This is not a market where you leave a stock from a perspective of 3 4 years and just buy and just forget about it, because the stocks could go down immensely if 1 or 2 quarters become bad. So that's the thing. Some of the macro factors that affect the markets. So external environment, threats and opportunities. For example, in terms of Dixon, if I come back to that, we had a situation about 2 3 years back when it was a situation where the chip shortages were there in middle of, I think, 2023 or 2022. There was a lot of chip shortages and the stock fell sharply. I think it corrected from around 5,000 to 2,500, something like that, 50% from the top due to that. And that was an opportunity in itself, because if you are looking 2 3 years forward, the shortages will not remain. So that's how you need to gauge whether that external environment threat is a permanent one, is something which is systemic in nature, which is going to continue, which is structural in nature, or something that is temporary in nature. So includes countries GDP and growth assessments as well. So when you talk about macro factors, GDP comes into effect if you're exporting your products, or you're an export oriented company. Then whichever country you're exporting to, suppose England is where a company is exporting to, and Britain is not doing that well, then that company will not do well. Raw material cost, as I said, chip shortages will mean a lot of cost on something like somebody like Dixon, from buying into that chips format, etc. And levels of competition and players in industry, this is extremely important. If you are the market leader, you can probably govern somewhat the type of margins you're going to get, especially in a duopoly, or in a situation where it's a monopoly. 2 or 3 companies are in there. You look at something like telecom, for example, at in 2008-9, about 15 17 years back, there were around at least 20 companies that I know about, and now there are two and a half left. So this is a kind of a monopoly, as you're seeing in telecom, and that's what is happening now, that the prices are going up of data, and probably it is going to continue to go up, and that's why Bharti Airtel is doing so well over the past 3 4 years. So level of competition, how much is the competition in that space? If the competition is extremely stiff, then you're going to see margins shrink, and that's what has happened with something like an Eternal. So if I open up Eternal in here, or Zomato, you'll understand I'm not saying that it's going to fall or go up, but just to give you an idea, how things pan out when there is stiff competition and people are fighting for gaining market share, etc. Because you need, it's a battle of survival, something like that. So margins from around 2.5% went up to 4%, 5%, and now that margin is shrinking, went down to around 4, 3, and now 1%. And this is what happens because you're going to burn cash in order to stay in the business, in order to be market leader in a very competitive environment. And that's why one needs to find out companies, especially sectors where there is monopoly in nature, if you have a 3, 4, 5 year perspective, and probably ride that wave altogether. Level of political interference is extremely important. So in telecom, if you see the PE, the valuations, what I was talking about. So if I look at something like Bharti Airtel, let's just look at Bharti at a PE of 40. I understand that's after the stock has gone up a bit from the lows. So if I look at here at around 1700 or so, or 10% lower, the stock was trading at a PE of 35, 36. That is the norm for this company, although the company is doing extremely well in terms of numbers and kind of monopoly has. But because of high government interference, and the government gives out, you can say, uh, all the spectrum, telecom spectrum, etc. That's why the PE is less in here. If there was no government interference, then this PE would have been easily 80, 90, 100, as we are seeing. With the government push happening in the electronic space, all the EMS kind of companies are doing extremely well with respect to the valuations, not in terms of the stock per se, but the valuation. So that one needs to take into effect. Consumption pattern of the region, any major technological change that is happening. So we have seen how BSNL and MTNL sank in the mid 90s, in the 90s altogether, and early 2000, and how mobile technology just steamrolled that kind of business. And we had a stock in MTNL and on the bourses, and it just collapsed. So technology is extremely important. And if you look at it here, you look at the uh, DMarts of the world. DMart went up sharply from around 600 all the way to 5,000, 6,000. A 10 bagger, a company that came to the market with 30, 40,000 crore market cap, became a 10 bagger in a matter of a few years. And then we are seeing how quick commerce, how delivery players are now eating into the business of malls, in departmental stores, or even kirana stores. So things change over a period of time. That's why analysis is extremely important. Over every 3 to 4 months, that is extremely important to analyze companies. Legal framework affecting the business is extremely important. So if you look at businesses which are into casinos, which are into gambling, which are into say the kind of so-called sin businesses like tobacco, you have liquor, etc. In those kind of businesses, the PE do not expand a lot, and the reason for that, you look at an ITC, etc., that doesn't happen because the taxes will keep on going up. There are legal issues. There's always a, you can say, a legal sword hanging by their neck in that respect. Global factors also which affect stocks: exchange rate fluctuations for IT businesses, for pharma, and any kind of business that exports a lot. Exchange rate is an extremely important factor. Political scenarios, level of stability. If you look at it, if you look at what is happening with respect to tariff, etc., we are seeing this. So this is the kind of political scenarios that we talk about, the kind of instability, the kind of volatility we could see, import cost and other tariffs that come in. You see US interest rates, economic job data. So if US economy, suppose a company, as I explained, say a Tata Motors, say metal companies, say any company that exports to Europe, and if Europe is doing extremely bad, even if Indian markets do well, Nifty do well, and all, these kind of companies will not do well, and they will try to struggle. I give you a example, a very interesting example, and I have traded into this stock. This is a smaller company that I want to uh, talk to you about, and this is again not a recommendation or anything of that sort. The stock is around 800. The stock has gone up recently, but just about 6 months back, the stock was languishing around these 600, levels. Now if you look at it, the numbers per se, again in the March quarter, they did similar numbers. So you look here, from 310 crores in 2021, they did 484 crores, and this was all looking hunky dory for carousel. But then this is the figure, mainly sales stopped, and stopped in a manner is that from 484 it went to 594, 684. So just consistent 15-16% growth from a growth of 40-50%, and that's why the stock shrunk. The margins from around 22% shrunk to around 18%, 17. And this happened because their major business of selling their products have been in Europe, especially in England, and that economy has not done well over the last 2-3 years. So this is another example where things can go south very quickly. So that happens. You have the trade war that is happening with US, and the US China war, that in which we don't know how much tariffs eventually would be in some of the sectors, and that's where some of the companies are hurting big time, and we are seeing that happening. You have the fishery industry, you have other kind of industries which are into that space, into the export space, that are not doing well. Look at IT, how that is shrinking, because if the global economy is not doing extremely well, fringe expenses such as into IT for companies in Europe and US would be extremely difficult. Oil price fluctuation also affect, but in that sense, oil needs to go up sharply, say to 90, 100, $110 per barrel, then it will affect greatly a country like India, which imports, their biggest import is oil. So that is a factor to be concerned about, but from a longer term point of view, it doesn't affect much, because for the last few years we are seeing that oil has remained steady between 60 to $80 per barrel. So major numbers to look at in a stock, as I explained, market cap. I was explaining that in my last video. You can check that out last Friday, that market cap to sales is extremely important. If I come back to Dixon just for a minute, you'll understand that one matrix was to look at the P. The second one is market cap to sales. So here it is trading at somewhere around 2.28 times, 2.3 times. You can probably look at how the sales numbers have been, and sales have been growing, and market cap to sales numbers have been going down. So over a 5 year period, the average is around 2.7. The stock is trading at 2.3, which is very reasonable. If you take into perspective only this factor, from a 10-year perspective, the market cap to sales average is around 2.1. It is coming there. So probably if it comes to around 2 times market cap to sales, that would be a very interesting level to look at something like Dixon, purely on the basis of, if you're presuming on the basis of that the sales is going to grow significantly from here over the next 2-3 years. And in that sense, the market cap to sales will look even smaller. So for example, in the example just recently, from around 39,000 crores, I said that if they're going to grow by 30% for the next 2 years, around 66,000 crores. Based on that, the market cap of the company currently is around 89,000 crores. So that means that is trading at somewhere around 1.3, 1.4 times a 2 year forward. So you probably can gauge the valuations as well, and make a decision in terms of market cap to sales as well. That's where market cap comes into effect. Sales growth is extremely important. Sales growth needs to be more than 20% from a longer term point of view for a stock to grow. Profit growth is the most important thing, but sales is also extremely important. Profit can grow with the various factors: interest coming down, you have depreciation coming down, net profit could grow. Market cap to sales, as I explained, PE, as I explained, that PE could be different for different sectors, and you need to understand how PE works for a particular company as well. You need to analyze that company over a period of time to analyze what sort of a valuation with respect to PE the market is giving the company. And dividend yield is important when you are considering whether the whole market, say a Nifty or a Sensex or a Dow Jones, Nasdaq, etc., all these FTSE and so on and so forth, is expensive or not. Rather than looking at a company per se, because dividend yields could fluctuate, but on a holistic market front, dividend yield could give you a very good sense that if dividend yield is extremely high, then the market could be cheaper. If dividend yield is extremely low, the market could be extremely expensive, because the market, the prices would have gone up so much of all the stocks in that particular index, that the yield has gone down. Operating profit and margins, very important factor. So if you look at it, margins need to improve in Zomato, as we saw that the margins were shrinking. In Dixon here, if we see, the margins have remained stable or around 5-4%. So if the margins really go up, say 5%, 6% and all that, then the stock will go up even further, even with lower sales growth. If the sales growth is not extremely low, but slightly lesser, but margins expand, that means the company is gaining market share mostly. And that is why the investors, like, the best figure that any investor would like is margin expansion. That is extremely important, that the margins need to either remain stable in a difficult environment or need to expand. Net profit margins need to expand. Debt equity, a simple, you can say, rule of mine is, in most of the cases, whatever stocks I buy, I normally buy into zero debt or very low debt companies. Simple as that. I don't get into stocks which are into debt, say a real estate, infrastructure, unless there is a huge rally in there, unless the valuations are extremely attractive, or I understand that there is an extremely big push from either corporates or government with respect to infrastructure spend that happened in the defense space over the last 4 or 5 years, from 2020, especially from 23 onwards. And we played that out well. Patreon members would be knowing about how Titagar went up from 230 to 50, etc. So that we can play as a trade, but from a long term point of view, I don't think that the I don't think you can play the real estate, infrastructure, and all those kind of spaces which are into debt for a longer period of time. So that's into it. How are the promoter and institutional holding? That is also important. If the FIIs have bought into the stock, if there is large investor buying into stock at lower levels, that would definitely be a very good green flag for you to get into the stock, and probably at least analyze the stock big time and then take your decision. If FIIs and DIIs are selling into the stock and selling it big time, then you need to be aware as to what is happening, because that happens before the numbers come out. Numbers come out later. The big players move out earlier, so you need to be extremely vigilant. And that is why I believe, even from a longer term point of view, you need to have stop losses in place so that you don't lose a big time. Again, pledging is extremely important. That is what has happened with Gensol, and we all know about it, that the pledged shares were a lot. And normally 1-2% of pledging happens even with large players, even with large IT companies. I've seen pledging of 1-2%. That's okay. But if you're pledging, say, more than 5-7%, more than 5% of your shares are pledged, 8, 10, 15, if that number is just ballooning, then it is a huge red flag. You need to be away from such stocks, even if those companies are doing well. So this is another video of mine on Market Gurukul and how I analyze companies. Please like and subscribe my channel, hit the bell icon so you get my videos straight away when I post it, and kindly support me.